Asian stocks fall as investors track regional tech shares after Nvidia's earnings. UK inflation jumps more than expected, rising above the Bank of England's 2% target. And Indian billionaire Gautam Adani, indicted in New York, is charged with bribery. Hello, I'm Taiba Aydin with the latest business and finance news here on TRT World. Asian equities fell on Thursday, with investors watching tech shares in the region after chipmaker Nvidia posted its highly anticipated earnings. AI darling Nvidia reported a 94% surge in revenue for the third quarter to over $35 billion. Net income during the three-month period rose to $19.3 billion versus the $9.24 billion in the same period a year ago. The chipmaker says it expects around $37.5 billion plus or minus 2% in the current quarter. Nvidia has been a primary beneficiary of the AI frenzy over the past year, with the previous 3 quarters sales rising 122%, 262% and 265% respectively. Let's get more on this now with Inko Cho, financial market strategist at Exness, who joins us from Kuala Lumpur. Good to have you with us on the program. Now, Nvidia posted some strong results and strong guidance, but investors don't seem to be too impressed. Why is that?
Good morning. Thanks for having me. Well, investors have highly anticipated Nvidia's third quarter earnings after the market closed, as the company's massive market capitalization of $3.6 trillion suggested that its stock performance could greatly influence overall market volatility. In a nutshell, Nvidia's third quarter earnings surpassed market expectations. The EPS stood at 81 cents, notably higher than the market consensus of 75. And there was also a remarkable 94% increase in total sales, alongside a robust 106% surge in net profit. But the stock price fell slightly, declining by approximately 2.5% in after-hours trading, despite they have delivered a solid third quarter performance. And this drop occurred as the company's fourth quarter sales guidance fell short of Wall Street's elevated expectations. And the decline in stock price also reflects a shift in some investor psychology, as Nvidia has consistently dominated the overall market sentiments, and expectations have soared to such heights that meeting the market anticipation is becoming increasingly challenging. Of course, it's a stretch to say that Nvidia's stock price will decline continuously due to the recent market disappointment. It is very important to highlight that after the last earning calls in the previous quarter, Nvidia's stock price dropped by 6%, but it quickly recovered and rebounded almost to 20%.
Right, and Nvidia has issued a guidance of an around 70% growth in sales in the current quarter, compared to over 260% that we've seen in the past. Does this suggest a slowdown in demand for its AI chips?
Well, the slowdown in guidance for the fourth quarter compared to the previous should not be interpreted as a decrease in Blackwell's demand. Instead, it is clear that the main factors behind this slowdown in guidance are supply issues and some doubts in the market, and the base effect of excessively optimistic market expectations toward Nvidia's earnings. In that respect, the growing focus on AI suggests that demand for Nvidia's Blackwell is likely to remain solid for the foreseeable future. And as interest in AI continues to capture the market's attention, the doubts about the chip demand seems minimal. But it is very important to address the supply constraints that could impact this growth, and surely the investors are worrying about that. And in that respect, in the conference call, Nvidia CEO Jensen Huang confidently stated that Nvidia's production capacity is still very solid, and directly addressing the recent market concerns. And it seems like his comments were aimed at dispelling recent worries about the Blackwell overheating issue. And he also affirmed that Blackwell production is in full swing, enabling the company to supply a higher volume of black well than previously expected.
Okay, Inky Cho, financial market strategist at Exness. Thank you very much for that analysis. UK inflation accelerated sharply to 2.3% in October as energy prices rose with the onset of winter. This has put pressure on the Bank of England to delay further interest rate cuts until next year. Tulay Kalyon Haznedaroglu reports from London.
According to the Office for National Statistics, inflation has risen more than expected due to an increase in energy bills.
Well, we know that cost of living is a continued problem for working families across the country, but it is good news that inflation is stable and close to target at 2% today. Well, the budget fixed the foundations in this country. It turned the page on economic instability that we saw under the previous government.
The recent inflation rate exceeds the Bank of England's target of 2%, which can impact future interest rates. Inflation reached 2.3% in the year to October, marking a larger than expected rise from 1.7% in September. And according to a study by the Social Metrics Commission, more than 16 million people, or 24% of the UK population, are defined as living in poverty, reaching the highest level since records began in 2000. Data shows that from January 2021 to May 2024, the UK has the highest increase in consumer prices among major economies, rising by 22.8%. That's compared to 20.9% in Germany, 18.8% in the US, and 16.6% in France. There are also concerns that inflation could be fueled even more as newly elected US President Donald Trump's trade tariffs could increase to 20%. Higher inflation is driving up the cost of living, affecting households across the UK. And with interest rates staying high, credit cards, mortgages and loans become more expensive. Also, with essential goods rising in price, many are feeling the financial strain. With inflation continuing to climb, the journey ahead is uncertain. But one thing is clear, its impact will be felt by millions across the UK. Tulay Kalyon Haznedaroglu, TRT World, London.
For more on this, we're joined by Vicky Price, economist and board member at the Centre for Economics and Business Research. Thanks for being with us, Vicky. Now, what are the main drivers behind this unexpected rise in inflation, and how is this impacting households?
For the moment, the main reason why we saw this increase in October, the data for October, was because the energy price cap, which is what households have to pay for the gas and electricity, has gone up by 10%. And that's quite a substantial increase for everybody. And that has fueled the change that we have seen from 1.7% in September to 2.3% in October. Loads of other items, in fact, contributed negatively to inflation. So the overall trend is a good one, even though service inflation has remained high at about 5%. So the forecasts that are being prepared by the Bank of England, by the Office for Budget Responsibility, the independent body that produces the economic background for the budget, suggests that inflation will stay around target for quite some time to come. But there are some concerns for the future, particularly coming from the changes that have been announced in the budget of October 30th, which are increasing employers' taxes by increasing national insurance contributions they have to make per employee. And there is a worry that companies will react by just putting prices up. So there will be an upward trend from that point of view. And all the forecasts suggest that although we'll stay near target, we're not going to be as near as would have been the case before those changes in the budget.
And how would this impact the Bank of England's gradual rate cut strategy?
Well, we've already had, in fact, the governor of the Bank of England say that they are looking to cut, or at least that was the implication, that they are worried about what will happen to the economy because of those tax increases, but that they will be expecting more cuts to come ahead. So December, I think, is almost a sure bet that there will be another 0.25% cut. And that is entirely possible, and that it will be continued into the new year. So there will be more cuts coming. The question is whether they will go down to the levels that we had anticipated earlier. In other words, how many cuts there might be in 2024 25. Other central banks will be cutting, the European Central Bank quite likely in December as well. So we'll see, of course, what happens in the US. That would be very important. That would be, if you like, the second cut after the elections, possibly that we'll see, or the vote, if you like, for President Trump, that we will see coming in December.
All right, Vicky Price, we will have to leave it there. Thank you very much, as always. Now a quick look at some of the other top business stories from around the world. Elon Musk's Neuralink has received approval for its first clinical trial in Canada. The brain chip aims to help paralyzed people control devices with their thoughts. Neuralink has already tested the implant on 2 US patients with success. The company also plans to develop technology to restore movement and vision. Shares of US retailer Target plunged more than 20% after forecasting flat holiday quarter sales and lower than expected profits. The company expects earnings of up to $2.45 per share. Despite offering discounts and expanding its deal-worthy brand, Target is struggling to attract shoppers. Meanwhile, rival Walmart raised its sales and profit forecast, gaining market share in groceries and essentials. Apple has proposed a $100 million investment to build a plant in West Java, Indonesia, focused on accessories and components. The decision comes after the country imposed a ban on iPhone 16 sales for not meeting the requirement of 40% of locally made parts in smartphones. The investment signals Apple's commitment to complying with Indonesia's regulations and strengthening its presence in the region. And how much would you pay for a fresh banana? Well, over $6 million at this New York auction. This banana, a conceptual art piece named Comedian by Italian artist Maurizio Catalan, has been bought for $6.2 million by cryptocurrency entrepreneur Justin Sun on Wednesday. Its starting price was $800,000 and the bidding stopped in about 5 minutes, surpassing a pre-sale estimate of $1.5 million. Welcome back. Asia's second richest person, Indian businessman Gautam Adani, and 7 others have been indicted in the US for paying $250 million in bribes to secure $2 billion in solar energy contracts. They allegedly misled US investors while raising billions of dollars, facing charges of fraud and conspiracy. The SEC has also filed civil complaints, but Adani denies the allegations, calling them baseless. Smita Sharma has more from Delhi.
This is a damning and a latest blow to 62-year-old Mr. Gautam Adani, one of India's richest and most powerful businessmen, a business tycoon whose conglomerate extends from ports, airports to renewable energy across several countries. In several places, we have seen a monopoly of sorts by Mr. Adani, somebody who's perceived to be extremely close to Prime Minister Modi and has been attacked consistently by the opposition, in particular Congress leader Mr. Rahul Gandhi, who also held a press conference following these reports of the US indictment by a Department of Justice that essentially alleges that Mr. Adani paid bribes to the tune of $250 million plus and counting to several state governments in India for selling his solar plants, and that all this information was also concealed to US investors, of course, on US soil. Now, Mr. Adani, remember, has been at the center of various controversies. In 2023, the well-known US short seller Hindenburg had, of course, come out with a report talking about the malpractices and corruption as far as Mr. Adani's companies were concerned. These were allegations that were vehemently denied by him. Now, so far, comments haven't come in from Mr. Adani or even the Indian Foreign Ministry. But the timing is also quite interesting. In fact, just after Mr. Donald Trump won that US election, Mr. Adani had taken to the social media platform X, previously known as Twitter, and written a long congratulatory post to President-elect Trump, also promising to invest to the tune of $10 billion in the United States.
Japan's exports have picked up in October, rebounding from a 43-month low the previous month. Though exports are rising, the economy is still in a challenging position. The Bank of Japan has raised interest rates and there's the threat of tariffs by incoming President Donald Trump. Emre Boz has the story.
These ports in Japan are getting busier. Japanese exports rose faster than expected last month, up 3.1%. It's largely thanks to a pickup in demand from China for Tokyo's chip-making equipment. And exports to regions like the Middle East have also risen by more than 35%. This is due to Japan's specialized export platform in the United Arab Emirates, which has been marketing Japanese food since August. But despite Tokyo's efforts, a trade deficit persists, with imports outpacing exports by $3 billion in October. That was a fourth straight month of deficits. This is having an impact on domestic industries and growth. Already, the economy's growth has been lackluster since 2023, and in the third quarter of this year, its growth rate declined to just 0.2%. So what's the Bank of Japan doing about all this? Last month, it kept interest rates steady at 0.25% to tame rising prices. Inflation has roughly been between the 2 to 3% range this year, and the BOJ says numbers are in line with expectations. That is, it could fall to the target of 2%.
Looking at domestic data, wages and prices are moving in line with our forecasts. As for downside risks to the US and overseas economies, we are seeing clouds clear a bit.
But are these clouds clearing? Higher interest rates will make borrowing more expensive, stifling consumer demand. As spending falls, so too will domestic production. And now, with the recent US presidential victory for Donald Trump, analysts fear a rise in tariffs between the US and Japan is on the cards. This all part of Trump's America First policy. And if this happens, Japan's economy will likely see weaker growth for years to come. Emre Boz, TRT World.
Let's cross now to Seijiro Takeshita, Professor at the School of Management and Informatics at the University of Shizuoka Graduate School. Good to have you with us, Professor. So what is driving the rise in exports in Japan at the moment?
Well, at this moment, we're getting pretty good strong demand from China, in particularly about the semiconductor manufacturing equipments. Partly possibly because of the embargo that we're getting from Sullivan Doctrine in the States. I think the Chinese are trying to really beef up on this area. But as you reported, obviously, we're getting a very big problem of the deficit that's continuing because of the rising commodity prices.
How would you describe Japan's growth recently, and is the Bank of Japan's decision to keep rates steady the right move?
Well, actually, it's not rising to the rate, but in my opinion, it's much more of a normalization of the rate. But that said, they're in a very difficult position because, as you just reported, we will have a lot of geopolitical ambiguity that's going to come, particularly from the United States. There could be a lot of unnecessary political gluts that would basically stop the globalization from proceeding. And again, as you reported, that is what is going to hinder Japan's growth possibility the most. So this is something that we're all watching at this moment. But one of the worst thing about the Trump administration is that it is very difficult to guess what they're going to do, because other administration, we can kind of make a guesswork, but it's very difficult to do that for the Trump administration.
Right, and as you say, it's difficult to tell what is likely to happen. If the Trump administration were to impose tariffs on Japan, how would that impact its export-driven economy?
Oh, it will hurt them very much. Let's not forget that Japan's biggest partners are China and the United States, but particularly considering the fact that, we also are in a very delicate position where yen is weakening. And Bank of Japan is not in a really position to start to raise the rate from here onwards, considering, our conditions of the economy, as you just reported. So what we're facing here is possible threat of inflation that is continuous. And of course, countries like, UAE or Saudi Arabia, who are basically in the transactional 25, who does not really pair with the Western nations nor the unitary nations, they're basically, are not really going to get necessarily overly affected by the Trump administration, which means that, it could be a very, very negative scenario for Japan if the oil prices start to rise and the yen weaken. That will be a double negative issue for the Japanese economy as a whole. So this is one of the threats that we're likely or possibly going to face in the future.
And what can we expect for the Japanese economy in the upcoming year?
Well, actually, things aren't looking that negative. We are seeing fairly good inbound demands. Private consumption is expected to rise on expectation of a wage rise that is going to take place. And as you just reported, exports are fairly brisk. But, all these things are possibly being hindered by the political moves in the States and also, external factors such as, rising oil prices, which could be easily triggered by the unstable geopolitical issues, both aggression from China and also from the Trump administration in the United States. So these are the things, external factors are things that is very unpredictable and what the Japanese are bracing for at this moment.
Okay, Professor Sejiro Takeshita, we will have to leave it there. Thank you very much for joining us.
Thank you.
Now, Islamic finance may have its roots in Muslim-majority countries, but today it's a concept that's gaining traction further afield. It's a financial system based on Islamic law which prohibits interest and promotes risk-sharing, ethical investing and assets-backed transaction. It emphasizes principles like fairness, transparency and social responsibility, ensuring that investments avoid activities considered harmful or unethical. Industry experts predict Islamic finance assets will reach nearly $5 trillion by 2025. This marks consistent growth of 10 to 12% annually over the past decade, reflecting increasing global interest. While the markets being led by majority players including Saudi Arabia, Malaysia and Turkey, non-Muslim majority countries like the UK, South Africa and Luxembourg have also been drawn in by the ethical principles and Sharia-compliant financial products. Earlier this week, we spoke with the General Secretary of the Islamic Financial Services Board, Dr. Ghayath Shabri, to explore the factors behind growing interest.
We've seen rapid growth of Islamic finance in countries where they are majority non-Muslim countries. And that is because of a number of reasons. One, the rest of the world is discovering that Islamic finance is not for Muslims only. Anybody can benefit from it. And also they are discovering that the instrument that Islamic finance is using is very familiar to them. They use leasing, they use deferred sale, they use partnership kind of thing. These instruments exist in every society. And they are also discovering that Islamic finance can bring solutions to problems that continue to exist in conventional finance, like in social finance, in green finance, in financial inclusions. They also found out that Islamic finance are probably more stable than conventional finance in many ways. We've seen this through the many years. We've seen this through the global financial crisis, through the COVID crisis, where the Islamic financial industry fared very well compared to the conventional finance. So all of these attributes are creating an interest in the rest of the world to try to find out what is it about Islamic finance and what can the rest of the world benefit from Islamic finance. And we think they do benefit from the industry. And we are hoping that more and more countries are going to allow Islamic finance to operate. Right now, well over 100 countries, Islamic finance operate well over 100 countries around the world. And we expect more and more to come. These new products have different characteristics. They have different profile in terms of risk, in terms of return, in terms of liquidity, in terms of collateral. And these different profiles are attractive to investors. They create different class of assets for investors and for financial institutions. So they have been very competitive, and that competitiveness showed up in the rapid growth the industry has been consistently experiencing over the past 25 years in the double-digit almost. It started not less than 3 decades ago with zero assets, and now they are in over $4 trillion in terms of assets. And that just gives you an indication how competitive the industry is. Turkey has made enormous progress in terms of Islamic finance. I'm visiting Turkey today to discuss with the Turkish Participation Banks Association, and we had meetings, and we were quite impressed by the progress they have done in putting together the regulatory framework to support the industry. We understand now the legal discussions are going forward, and that is a fantastic step going ahead. And given the position of Turkey and its G20, a leading economic power in the region, they could easily, I can envisage Turkey become a regional hub for Islamic finance.
Well, that's all your business news for now. Thanks for watching. The Newsmakers is next.